If you have, Donald, give me a link. Hi YouTube, welcome to our weekly lesson. Please give me a moment as I go live on Facebook. Give us just a moment, please, as we go live on Facebook. Well, hello Facebook. We are live on Facebook. Welcome everybody. My name is Sami Abu Saad. I am Director of Education at E3 Live, and we are doing our lesson number 19, I believe. Started this lesson series back in March. If you would like to catch up on previous lessons, I dropped a link in the description of the video. It's called Sami's Facebook playlist, where you can, if you click on it, it'll take you, you can check all the videos that I've ever recorded on social media, pretty much. The same playlist is available also on YouTube, but for now, I want to say, let's go ahead and get started. Actually, before I start, I need to show you this standard required disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. So just keep that in mind. If you like today's video, be sure to hit the like button. Also be sure to check out the links in the description. I just added a brand new link to the ultimate guide to trading earnings season. Check it out. It's an article written by T3 on how to trade earnings season. Brand new article. So check it out. It's in the description of the video. All right, without further ado, let's go ahead and get started. Today's lesson is about about amplifiers, things or events that make the setup even better, that put the odds in your favor, stack the odds in your favor. But in order to, before we talk about that, I want to review not the previous lesson, but actually lesson number 13, because I want to go over the main setup that we use these amplifiers with, and that is called the T3 buy setup and the T3 sell setup. The T3 buy setup is made up of one key criterion. The T3 buy setup is key to capturing robust 3 to 5 bar trading gains. Is often used, T3 trained traders often use this one setup alone to trade any market, and the T3 buy setup is scored 20 points in the T3 trade score system. It can be found and traded in all time frames. So if you're a day trader, you can trade it on the intraday charts, swing trader on the daily. If you're a long-term trader, you can trade the setup on the weekly and the monthly charts, on any and every time frame. It's applicable. All right. So what is that key criterion? Anybody know what it is? What is that key requirement? And here it is. Very simple. 3 or more consecutive lower highs or 3 or more red bars. If you get that, right, you basically, in theory at least, have a setup. Now, optional item would be 3 or more consecutive lower lows, because that means there's continuity, there's fluidity, right? There's momentum. The stock is not stuck trading in a range, it's moving. So 3 or more red bars, three or more lower highs, that's the requirement. The optional item is 3 or more lower lows. Having both makes the setup more potent. Now, the action steps you want to buy once the red bar's high, the last red bar's high is taken out, is breached. So 1 penny above, place the stop either under the entry bar's low, in this case right here, or under the prior bar's low, whichever is lower. Basically, place the stop under the pivot. Establish minimum target at or slightly above the prior pivot high. This area would be the target. And basic management, which beats what most people do. After 2 bars in your favor, 2 green bars in your direction, place a trailing stop under each prior bar's low until you're trailed out, you reach target, or you get a wide range bar, in which case you want to just take it if you get a wide range bar. Okay? So that's the setup. Let me show you some charts. See this? three or more lower highs. In this case, 2 red bars, but we have 1, 2, 3, 4 lower highs. So that meets the requirements. Buy above the last bar's high, stop below, target the prior highs. After the stock goes up 2 bars in a row in your favor, you can start going bar by bar. So you raise your stop to under the last bar's low until you're trailed out, target is reached, or you get a wide range bar, in which case just get out. Setup on the daily chart. Notice this was also a transitionary setup, meaning the stock was in a stage 1 and transitioned. Buy setup here, long, stop, and target. 2 days later, this is a daily chart. It got to the target. Now, we call it basic management because that's what we recommend you start with. But later on, you can deploy advanced management tactics. For example, in this case, that's a transition A. You don't want to be getting out here. You want to be looking for it to break above the transition A. Does that make sense? And just bar by bar would have kept you in it. And this is not, this wasn't like a perfectly selected example. Here again, bar by bar would often keep you in the play much well above the prior pivot high, right? Well above the prior pivot high. And then once it gets taken out, you're out. Once it gets taken out, you're out. Once the last bar's low gets taken out, you're out. Does that make sense? But these are buy setups on the daily chart. Buy setup on the daily chart. Notice just raising the stop under the last bar, under the last completed bar. It would have taken you, who knows, I don't know where it ended up going to, but obviously above even the prior pivot high. Same here, buy setup, pretty nice, out right here. This was a buy setup, but we like buy setups that come from V pivots. So in this case, it was a rounded top, and we also like them to stay at the 20, not break below it. If the pullback comes from a rounded top, or if it's a deep pullback, or if it's both, you can always look to do it on the secondary entry, on the W pattern. So in this case, don't do it on the first entry, but the second time it takes out a prior bar's high, then you can do it. So in this case, the first time it took it out should not have been played. Second time right here should have been played. Does that make sense? Because uptrends tend to continue. And this was just a retest and failure, or a W pattern, which is what a W pattern is a retest and failure that we deploy, that we use when it's a deep pullback that breaks the 20. Okay, so that's the main setup. Now, why is that the main setup? Well, simple. Because stocks correct through time by going sideways, in which case you get the breakout, or through price by pulling back. That's it. That's pretty much it. So what we talked about here so far is correcting through price by pulling back, not through time by going sideways. This setup we actually covered in previous lessons. And we covered the pullback play, or the buy setup, in lesson number 13. I'm just reviewing it here. You'll find out why in a few minutes. So to the downside, the sell setup is the same exact thing as the buy setup, but to the downside. But here I'm showing you a little more detail. I didn't want to give you this much detail because I didn't want you to get confused, right? So when we're talking about a buy setup, we want the stock to be in an uptrend. Okay, so we go back to this pattern, that's a buy setup. We want it to be in a stock that is actually in an uptrend, meaning what's an uptrend? We talked about what an uptrend is. We defined it in detail in the past. Higher highs and higher lows, higher pivot highs, higher pivot lows. So anytime you have, I'm gonna start my annotation tool one more time because it's getting stuck here. So if you have a stock that is putting in higher highs, higher lows, like so, that's called an uptrend. Does that make sense? Now if you have a stock that also has a rising 20 above a flat or a rising 200 MA, so much the better, right? So that's an uptrend. So we don't want to go around buying buying stocks that have just 3 bars in a row, You don't want to do that, or be, watching stocks. Anytime you have a stock that puts in 3 red bars, you're automatically watching it, looking to play it. No. But you do want to watch stocks that put in a 3-bar pullback if it's in an uptrend and at the right location. We discussed the location items in previous lessons. We'll address them also in the future. The main location items are the rising 20 MA, minor support, which we haven't covered yet, the correct retracement percentage, which is in the range of 40 to 60%. So those are the 3 main location items. Again, 20 MA, minor support, and retracement in the range of 40 to 60%. Now, when we're talking about a downtrend, we want to make sure that the trend is down, right? So we are looking for macro bear stage 4. And then I don't want to read this for right now because we covered this in the past. And then we want to go short when the micro is in alignment with the macro. For example, when the stock is currently, so macro stage 4 is in a downtrend, great. But while it's starting to pivot to go up, you want to wait. You don't want to do anything yet. Macro stage 4 with the micro stage 2, stock is moving up. You want to stock it, but wait. Macro stage 4, downtrend with a micro stage 3, get ready. And then macro stage 4 with a micro stage 4, strike. So one more time, what I'm talking about is, just so we're all on the same page. Okay? What I'm talking about is this. I'm talking about a stock that's in a downtrend, like so. But when stocks are trending, they don't fall in a straight line. They don't rally also in a straight line. They have a zigzag movement usually, like so. So if the stock is in a downtrend, you want to strike, you want to go short when the wave, or when the micro trend is in line with the macro. The macro being that the stock is in a long-term downtrend. The micro are these waves. So when you have these swings, when you have a swing to the downside, that's when you want to go short. Where do you go short? Just under the last green bar's low. Does that make sense? So that's what we're talking about here. Again, review lesson number 13 if you'd like to get more detail on this. And so while the stock is moving up, we don't short it. When it breaks under the prior bar's low, that's when you go short. Short under the green bar's low, stop above it, target the prior pivot low. After 2 bars in your favor, go bar by bar, meaning keep lowering the stop to the most recently completed bar's high. 1 cent, 2 cents above it. You get trailed out, then so be it. You get to target, you can cover it. Or if, like me, you're a follower of the golden rule of trading, which says cut your losses short and let your profits run, I don't necessarily usually just take it at target. I keep trailing it, but I go to the smaller time frame. So if this was a 15-minute or a 30-minute sell setup, then I may go to the 5-minute once it gets down to the target and trail it bar by bar on the 5 or the 2 or the 1. Does that make sense? So I get really tight when it's at my target. But I like to keep trailing because sometimes you think, okay, this is a target, should stop here, and it ends up dropping a lot more. Does that make sense? Questions. Let's see. How do you know whether it is forming a W pattern at the rising 20 and we should wait for the next entry or not? That's a great question. You don't know for sure that it is, but what I'm saying is if you're not sure about the play, if there's something wrong with the play, for example, the pullback is pretty deep, it came from a rounded top, okay, or the pullback started with a wide range red bar, or it broke the 20, or if it's too extended, or if it went a little climactic prior to dropping. Those are all reasons for caution. Then pass on the first entry, and if it gives you a W pattern, then you can play it. If it doesn't, it just keeps going, then you will have missed out on it, and that's fine, too, because in that case it wasn't a good setup and it just worked. Does that make sense? So that's what I'm saying here is, if there's something wrong with the setup, if it doesn't feel right, if it doesn't look right, if, let's say, and again, I can give you a dozen things that could be wrong about a setup, about a buy setup. A buy setup is a pullback, like so. If there's a lot of candles at the top, the more candles, the more resistance. A rounding top or square top. The bigger the candles, the more resistance. The more volume the candles form on, the more supply, which means the more likely this buy setup is to fail. So you want to pass on the first entry and look to do the next entry. That's just one thing to look at, is to study the prior pivot high. We want pullbacks that come from V pivots, right? 1 to 3 candles is what forms, is how V pivots form. 1 to 3 candles, not more. That's the first thing you want to look at. Second thing you want to look at is the retracement percentage. How much did it retrace, right? We want it to be in the 40 to 60% range of the last move. We also want it to be at or near the rising 20, not below it or not far above it either. If you look to the left here, ideally you want to see some support. For example, ideally you want to see something like this, a pullback to the prior pivot high or to a base. Does that make sense? So those are location items. Oh yeah, thanks for the heads up. I'm drawing on the right. Okay. So far okay. Are we on the same page so far? But then you also want to look at the quality of the pullback. Do we have clean bars, or do we have overlapping candles like so? If you have overlapping candles, then the pullback is not very good, because when you have overlapping candles, it means people bought the stock and now they're trapped. Does that make sense? So you want to have a fluid pullback like so. Nice, clean pullback. You want also the stock to not have gone climactic. You don't want to get a big move up, because usually when you get a big move up, the first buy setup fails. So you automatically want to pass on the first entry. Question, can you point me to the previous lessons, right? Yes, I can. I'll give you the link right now. But if you're watching this on social media, there's a link in the description of the video called Sammy's Facebook playlist, and that gives you a repository of the last 18 lessons we did, okay, and a couple hundred more. Okay, all right, great. Other questions in the room here? Let's take a look. What time frame are you using to enter and exit the trade? Good question, Win. I'm using whichever time frame the stock is setting up on. So if the buy setup is, if I'm swing trading and the buy setup is on the daily chart, then I'm using that to manage my entry and exit. When it gets close to the target, I may drop one time frame lower, or I could drop even more, 1 or 2 time frames. But that's only if it's basically at the target. Usually you want to enter on the time frame where there is a pattern. If there is no pattern on this time frame, then, and I'm swing trading, and the daily is my time frame of focus, which is it is, then I don't even bother looking at that stock. Then I just move on to the next one. Okay. All right. Let's see. All right. Okay. So let's go back to what we were talking about. Again, you want to find buy setups that are on stocks that are uptrending or transitioning. In this case, the stock was actually transitioning. Next one, beautiful uptrend, rising 20. This is why we use the 20. It's a directional tool that speeds up technical analysis, that tells you whether the stock is in an uptrend or a downtrend. You see this moving average, you immediately know it's in an uptrend, right? Rising 20 in an uptrend. rising 20 and an uptrend. Now here, is it rising 20? No, then you don't get involved. It's too sloppy. Flat 20, declining 20. Now, when it's in a downtrend, you want to have a declining 20 MA. Does that make sense? So if we go back here, declining 20. And then in multi-bar rally, the requirement is 3 or more. In this case, we have 1, 2, 3, 4, 5 green bars in a row. Where's the entry? Under the last bar's low. So in this case, here's actually where the entry was. The correct entry, right here. Okay? Stop was right up here, above the pivot. And then the target was right there. After 2 red bars in a row, you start going bar by bar. So as soon as the second red bar is complete, then you put your stop above it. And then once this bar completes, you put your stop above it. Once this bar completes, you put your stop above it, and you got your target. Or if, like me, you like to continue managing, then just lower your stop right here, and you would have gotten trailed out. Or, as I said, if you get a wide range bar, then you just take it. You don't even continue to manage. Because oftentimes, after multiple bars down, if you get a wide range bar, that is indicative of a bottom, or at least a short-term bottom. Question from Win. Don't you check other time frames? Yes, I do. I do check other time frames to make sure I have multiple time frame alignment. For example, when I'm looking at this, this is a daily time frame. Let's just go back to this. If I'm looking at this and it's a 5-minute chart, which it was, I want to make sure that this stock looks good on multiple time frames. On the 2-minute, the most important time frames are the time frames that are surrounding the main time frame. So if this is a 5-minute chart, the most important time frames to make sure that they're in alignment with this time frame would be the 2 and the 15-minute. The 2 and the 15. But we'll talk about multiple time frame alignment in a separate lesson. It's probably the single most important topic or concept to grasp, because most traders trade on just one time frame. They don't even know that there are other time frames. I mean, when I started trading, I don't know what time frame I used, but I must have just come across it and thought, okay, this is the time frame I'm going to use, and was completely oblivious to other time frames. You can achieve short-term success when you're trading in a vacuum like this, when you're trading just on one time frame, but we want to check multiple time frames because prices are interacting. You want to look at the whole picture. So here's the whole picture. It's like a circle, right? The whole picture is like a circle. You want to make sure that you see the picture from here, from this side, from that side, from the bottom, from this side, so you understand what's going on with the stock in general. It's not a linear movement, it's more like a circular movement, almost. So you want to look at multiple time frames so you understand what the stock is doing on multiple time frames. We'll talk about that in future lessons, but it's probably one of the main reasons why trading can be a difficult business, because people fail to look at and check the stock on multiple time frames. All right. Question from Clark. You changed to a 15-minute chart in the afternoon. Why? Okay, so the question is, the question is, why do I trade off of mainly the 15-minute chart in the afternoon? The answer to that is because in the afternoon, trends get a little sloppy. They're not like the morning where you get a lot of momentum at the open. So I don't want to be triggered into plays based on the noise that's happening on the 1, the 2, or the 5, which are the other time frames that I use for day trading. So the 1 and the 2, especially the 1 and the 2, are reserved more for the morning action, right? For trading the open, because we don't have trends yet. Trends haven't yet established themselves, and you have to be really quick in the morning, otherwise you'll miss out. So I use the 1 and the 2-minute time frames mostly for the morning, early morning, 5-minute mid-morning, and I also use it to finesse or perfect my entry for the on the 15-minute later in the day. But I like to use the 15-minute because it's not too large like the 30 or the hourly, right, time frame, but not so small like the 1 and the 2 and even the 5. The 15-minute for me in the afternoon is the perfect time frame. Not too small to get sucked into the noise, but not too large that you'd have to wait a day or two before the play actually comes to fruition. So it's the perfect time frame. All right, and that's why it's my main time frame in the afternoon. Okay, so we talked about buy setups and sell setups. It's one of the two main setups or strategies that I use for day trading, even swing trading. For swing trading, I have other strategies, but for day trading, it's truly one of the two main setups that I use. There are other setups such as the climactics. When a stock goes climactic to the downside or climactic to the upside, you can fade it. That's the third setup. And then everything else is pretty much a subset. For example, we mentioned briefly the W pattern. What's the W pattern? The W pattern is basically a buy setup, but with a double bottom. Does that make sense? Everything else that I can think of is either a pullback, or a base breakout, or again a climactic. That's it. There are no other patterns, pretty much. You might say, well, what about the 1, 2, 3 pattern? You trade that and you like it. I like it a lot. Yes, I do. But it's basically a form of a breakout. And I play it on stocks that just recently broke out, and it's a way to get into that stock because I missed the initial move. I might have missed the initial move. So that's like a form of a breakout. Does that make sense? So everything is either a buy setup or a breakout, or in rare occasions, climactic buy, climactic sell, and vice versa. I mean, meaning we can have buy setups, buy setups breakouts, or sell setups breakdowns. Okay. Can we make this setup? What makes this setup even better? Three or more red bars in an uptrend to the right location. We got that. It gets 10 extra points. Are there amplifiers, events, occurrences that make this not a 20-point play, but a 30-point play, or a 40-point play, or a 50-point play? And the answer is yes. We call these amplifiers. And here's 8 of them. We'll talk about the additional. There are 10 of them actually. But here's 8 because these are the ones that are applicable to uptrends and downtrends. The other 2 are more applicable to sideways trends. Well, sideways, and we also have the reversal times. Okay? But the trading combinations or amplifiers are the bottoming tails, topping tails. That's the first one. Changing of the guard is number 2. The narrow range body or bar. Narrow range body is when the bar is average range, average sized, but the body is small. Narrow range bar is when the entire bar from top to bottom is very small. That's actually an amplifier. Volume, we don't mean just like any volume, we mean volume spike or volume increase. Above average volume basically is the amplifier here. Above average volume. That happens to form after 3 or more red bars, so on a buy setup. Okay? Minor support and resistance. Retracement percentage, again in the range of 40 to 60. Moving averages. And the T3 buy and sell zone, which we'll talk about in the future. For now, we're going to talk about the first amplifier, which is the bottoming tail, but let's read a little bit about the amplifiers. The T3 buy and sell setups you just learned about, used in conjunction with the following events, will actually help to raise the level of accuracy of these already accurate patterns, and typically generate trading profits at a faster and more powerful rate. Trading truly becomes closer to a science once one knows how to properly identify and exploit the moments when these powerful trading events occur simultaneously. Now we are going to delve deeper into the realm of professionalism, showing you how the T3 buy and sell setups, along with several other indicators and occurrences, can reap bigger profits. Keep in mind that each concept can be applied in all time frames. Okay. First amplifier is the bottoming tail, or the topping tail if we're looking short. A bottoming tail after a 3 to 5 bar decline indicates that the balance of power has shifted from the sellers back to the buyers. So you get red bar, red bar, red bar, bottoming tail. The T3 trader looks to buy. Okay? Looks to buy. A topping tail after a 3 to 5 bar rally indicates that the balance of power has shifted from the buyers back to the sellers. So you get green bar, green bar, green bar, topping tail. The T3 trader looks to sell or to short. Where is the entry? Entry for playing long would be above this bar's high. How much above it? However much you want. 1 or 2 or 3 cents above. Right? If the stock is spready, you might want to give it a little more, like 5 cents. Stop is right here. Target is at the prior pivot high. After 2 bars in your favor, start going bar by bar. Raise your stop. Raise your stop and target. Or you can raise your stop and then just keep trailing. And the same to the downside. If you get a buy setup plus a bottoming tail or a sell setup plus a topping tail, that gets 10 extra points, and now that setup is given 30 points rather than 20 points. And therefore, a buy setup with a bottoming tail equals a more reliable buy opportunity. A more reliable buy opportunity, and as I said, it gets 30 extra points. Okay. So now, having said that, not all bottoming tails and topping tails are created equal. The best bottoming tails are the ones that are called range expansion, meaning the range of the tail, the bar from top to bottom, is much bigger than the average bar. Those are the best bottoming tails, because how does a bottoming tail form? A bottoming tail is always a red bar. At the bottom, it was actually a big red bar. But the buyer stepped up and reversed it. Does that make sense? Quickly reversed it. That's usually a lot of money that went into the stock that cause it to change the bar from being a big red bar to now a hammer, a bottoming tail, right? So that's a lot of institutional money that went into it. But not only that, but think about the ones that played it, that were in it short, that shorted it as the stock dropped. Because the stock reversed quickly, they are now trapped. They're sitting on losing positions, and they're going to look to cover when the stock starts to move up against them. Their covering will propel the stock, will push the stock even higher. So a bottoming tail is good because it shows you a shift, a quick, strong shift in power from the sellers to the buyers. But it also is good because it traps people. People are not, they're not like you and me on keyboards, and I can get in and out of a position in the fraction of a second, right? No, they're grandpas and grandmas, and there's nothing wrong with grandpas and grandmas, but they're using the mouse and they're saying, okay, click short, and then I want to click out, and then the stock is already way above their entry, right? They can't even get out of it, especially if they're trading the high flyers like Tesla and Netflix and these companies, Nvidia, Amazon, Google, beyond, right? By the time they try to get out of it, it's already gone, and so now they're trapped. They're sitting on losing positions, and their covering is going to push the stock even higher. In order for a candle to qualify as a bottoming tail, the tail needs to make up at least 50% of the candle's range. Again, in order for a bottoming tail to be called a bottoming tail, the tail needs to make up at least 50% of the bar's range. So if we were to look at some of the setups we already looked at here earlier, this was about 50%, I would say, this bar. You can say that's a bottoming tail. This here, I just want to show you, that's not considered a bottoming tail bar at all. Not a bottoming tail. That's not a topping tail, right? That's not a topping tail. That's actually a bottoming tail, right? And remember, we are only interested in bottoming tails that form on buy setups. So after 3 or more red bars. So if I get a bottoming tail, let's go to the next chart. It doesn't have any tails there. If I get a bottoming tail, let's say right here. I mean, this wasn't a bottoming tail, but a bar. But let's just say this was a bottoming tail bar. Would I be interested in it? No, because it happened after. It didn't happen after 3 or more red bars. Does that make sense? So we're only interested in bottoming tails that come after 3 or more red bars in a row. All right? And we're not interested in bottoming tails if the stock is in a downtrend that doesn't have a pattern, because we wouldn't even be interested in playing it long. We're only interested if they happen on a buy setup. And topping tails if they form on sell setups. Does that make sense? So going back to the lesson here. So again, bottoming tails that happen after 3 or more red bars in an uptrend to the rising 20, okay, with multiple time frame alignment, but we'll talk about that later. Those are the ones that should make you drool, right? And as we said, buy setup with a bottoming tail equals a more reliable buy opportunity and gets 10 extra points. 10 extra points. Entry still the same, above the last bar's high. Stop is under the low, the pivot low, the lowest low basically. You can also put the stop under the entry bar's low, but you're basically being aggressive. You're reducing the favorable odds. You're increasing the reward to risk, because in this case, your stop would be pretty tight. Entry right here and stop right below, versus entry right here, stop down here. Bigger stop, but much more secure. Trading is a balancing act. You can't be too passive all the time. You can't be too aggressive all the time. So it's about being aggressive when you need to be aggressive. For example, what if you were just like as sure about it as you are about anything in life, this buy setup? Then sure, go ahead and put your stop right here, because you're just sure about it. And maybe by placing your stop at the lows here, it would seriously ruin your reward to risk, right? Reward is the difference between the target area and the entry. Risk is the difference between your entry price minus your stop price. So go ahead if you're really sure about it, or you don't have enough R to R on this unless you put your stop right here, then go for it. But trading, as I said, is more about a balancing act, knowing when to push it and when to back off. Okay? After 2 bars in your favor, go bar by bar until your target is met, or you get trailed out, or you get a wide range bar. All right? That's an example of buy setup. In this case, it was not really such a good buy setup with a bottoming tail, because it was extended away from the 20. But that's still, notice that the bottoming tail can be the 3rd bar. Doesn't have to be, you don't have to have 3 red bars and then the bottoming tail. It can be the 3rd bar itself. That also is okay. Not ideal, but is okay. Again, we want bars that make up at least 50% of the candle's size. Those are the ones that are called bottoming tails. Okay, anything that's less, like this candle here, this big red candle. Notice how it had a little tail? That's not considered a bottoming tail bar. It's just a little reaction at the bottom. But the ones that we're interested in are the ones that make up 50% of the candle's size. And further, the ones that we're interested in are the ones that happen on a buy setup. Not like here, that was a tail. But that was of no interest because it was not in an uptrend. Does that make sense? This pivot low, actually this is below it. One stocks that are in an uptrend. All right? And notice again, top and tail put an end to the stock, to this uptrend for who knows how long. Bottoming tail and the stock bottomed. Bottoming tails are signs that major institutional buying has just taken place. When bottoming tails form after a stock already declined several bars, the odds are pretty high that a bounce of some kind is very close at hand. All right? Okay, guys. Questions. Let's see. Does it need to be a bottoming tail? I'm sorry. Which one was that? Does it need to be a bottoming tail? It doesn't have to be a bottoming tail. We're saying if the setup has a bottoming tail, then it gets 10 extra points. So if you have a buy setup without a tail, that's no problem. You can still play it. With a bottoming tail, it gets 10 extra points. For those on social media, if you'd like to check out the Strategic Day Trader Room, where you learn a simple and accurate method designed to teach you how to trade with a vision that's clear and unclouded by emotions, meaning you learn an objective system to trade, okay? To trade the markets with. Feel free to check it out. There is a link in the description where you can actually try the Strategic Day Trader Room for 30 days for just 49 bucks. Almost free. Almost free. Once you're in there, start asking questions. Let us help you. Let us show you how we do it. And then we challenge you to find a better trading room. We do. The Strategic Day Trader won the award for the best trading room 2 years in a row when Trader Planet was conducting that survey and the public voted on it. At the time, to be perfectly honest with you, it was called the Black Room, and I was running it too, but it was called the Black Room. Now we call it the Strategic Day Trader. At any rate, I hope to see you there. Reach out if you have any questions, contact customer service, and with that said, have a great rest of the week. Take care, everybody.